Hello everyone, this is Rahul Jakaria from Sharekhan. Welcome back to exciting 3R actionable stock updates. 3R basically means right sector, right quality and right valuation. These are our investment ideas. Today we have an update on HDFC Bank. Our analyst maintains buy rating on HDFC Bank with a price target of Rs 1900. HDFC Bank delivered stable performance in Q1 except on deposit front and maintained its stance on staying focused on delivering stable business matrices in FY25. There was slight deterioration in asset quality. However, bank does not see any concerns and expect asset quality to remain range-bound. FY25 would be a period of merger transition. The bank is confident of regaining its growth trajectory and NIMs once this transition period is completed. We remain assertive from medium to long-term perspective. Key monitorables are NIM progression and retail deposit mobilization. At the current market price, the stock trades at 2.1 times its FY25 and 1.9 times its FY26 core book value estimates. The stock has underperformed the broader indices in last 12 months. Next, we have an update on Indian hotels. Our analyst maintains buy on Indian hotels with an unchanged price target of Rs 679. Q1 numbers were a mixed bag, with revenues growing by 5.7% year-on-year, while EBITDA margin rose 103 bps year-on-year to 29%, resulting in better than expected PAT growth of 10%. Q2 will be among the strongest quarter, with July revenues rising about 20%. Second half of 2025 will also see good growth momentum, led by higher demand from recovering foreign tourist arrivals and improvement in some of the key international properties. Excluding consolidation of Taj SATS, revenues should grow by over 10% in FY25. New business should grow by 30%. EBITDA margin will see consistent improvement in the quarters ahead. Next, we cover Persistent Systems. Our analyst maintains buy on Persistent Systems with a price target of Rs 5,220. Persistent System has been consistently delivering industry-leading performance since the past several quarters and is well placed to lead the growth trajectory in FY25 and FY26, given the strong order book, consistent addition of new logos, and robust capabilities. The company has reported strong quarter on revenue front in Q1 and is expected to deliver healthy revenue growth for FY25. The company's total TCV stood at $462.8 million, up by 3% quarter-on-quarter and up by 22% year-on-year, with book-to-bill at 1.4 times, providing strong revenue visibility. We expect sales CAGR at 17.1% and PAT CAGR of 25.1% over FY24 to FY26. At current market price, the stock trades at 51.8 times FY25 and 39.5 times FY26 estimated EPS. Last, we cover CIE Automotive India. Our analyst maintains positive viewpoint on CIE Automotive India with an upside potential of 21% on account of its focus on high OPM, consistent market share gain, rising traction in the EV space, and inorganic growth opportunity. EBITDA margin exceeded estimates by 110 bps and PAT came 5.6% ahead of estimates in Q2 of calendar year 24. Further, the India business to perform better in second half of calendar year 24 in comparison to its performance in first half. So the stock trades at price to equity multiple of 21.5 times and an EV by EBITDA multiple of 12.9 times in FY26 estimates.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.